Hey everyone, Daniel's here to give an overview of the market. Today's March 26th. Actually, this is March 27th, 1 o'clock a.m. So I'm doing a market analysis of the market ending March 26th, which is Monday. So today the market has bounced back pretty strongly, right? And if you look at the market right now, there's the one thing I want to bring you to attention is the market kind of major crash scenario I was talking about that we need to be aware of. Since a couple of videos ago, in the previous video, I did mention that our market right now is at a multi-year top, right? We're at a multi-year bull market, and the bull market has been around for 10 years. Although I'm not really the person who likes to talk about, market gonna crash, because if you think the market gonna crash, you can talk about the market gonna crash every day, and you're gonna miss out this entire bull market, right? I always have a bullish tendency in the market because I know the market's gonna go up in the long term. However, I know the bear market can come around pretty quickly. Like in a couple of days, the market could change significantly when the market's peaking. For example, in 2008, you can look at this. The market literally changes in a couple of weeks, right? And start going down. And we're in the 10th year, actually 9th year of this great bull market, starting from 2009 March, and we're exactly 9 years, right? And we have to keep in mind this market has been, I think, the second longest bull market in the history of the Dow Jones. And right now, the market is actually making a pattern that's very similar to 1987 and 1929. That's just how it looks like right now, but it doesn't mean this pattern is going to, follow. It's going to turn into a crash, right? But to keep that in mind when you're trading this, so one thing I'm looking for to invalidate this pattern is to looking for we have another pullback. I want to look for something like this tomorrow, right? And the coming few trading days this week is going to be very, very important because I'm looking for something like we have a pullback. Tomorrow we still keep going up, and we are able to hold this level. If we were able to hold this level for a couple of days, then that basically invalidates the market crash scenario. It means the market's going to consolidate, and possibly we're going to have a uptrend again. However, if the rally, we have a rally tomorrow, then it fails and keep going down again, that definitely needs to bring us into attention. We have to cut our long position, because if that happens, let me just show you the chart where we are right now. That would make this a literally walking the same pattern as 1987 and 1929, right? This point is equivalent to this point, this little bounce in 1987, and this bounce in 1929, just before the crash, which begins the Great Depression. And this bounce is literally a dead cat bounce, right? Right now, we don't know if this is a actual bounce, actual bottoming, or is a dead cat bounce. We had to really just to watch it tomorrow and the rest of the week. So another thing I need to bring you into attention is that the market. There's a article about. I read a long time ago regarding to the similarities of 1987, 1929, how the human behavior stays the same even 56 years later, 60 years later, that the human nature has now changed, and you know George Soros, Paul Tudor Jones, all these great investors, they were able to make tons of money during the 1987 crash because they were able to use the chart from 1929 to predict the crash in 1987. If you look at this side by side, you can see that the chart looks very similar. And even in terms of time frames, very similar. One thing in the article I remember they talk about is that the 1929 crash and 1987 has striking similarities in terms of how fast the duration of crash happens. You can see that they're from the actual peak of the market to the second peak of the market. It literally in 1929 it takes 29 bars, and in 1928 it takes 28 bars, and from the peak of the market to the day before the crash to the peak of the market to the day before the crash in 1929, it takes 38 trading days. In 1987, it takes 37 trading days. So it's literally happening in a tick by tick basis, right? Then, when I look at the peak of, we don't know if this is a peak or not because we have not, made a lower low yet, so we don't know if this is a double top. Okay, this is not a double top because we have not break the low below, right? We had to come down and break this low to say this is a double top. So we have not break a low, so this could keep going up, and this would invalidate the top of this top. But let's assume this second top right here for the S&P. You can see that right now the distance between the first top to the second top is 30 trading days, which is not really far from the 1929 and 1987. Actually, the time frame is very similar. And this pattern is kind of interesting because when I'm looking at 2008 peaks and all that stuff, I did analysis. The time frame is very different. It was like 40 days, 50 days, 60 days. But these two peaks, this pattern is actually very similar. And also you can see that after the second peak, this thing has a kind of it keeps going down, then it has this kind of bounce, right? Now we have this bounce again. So we don't know if tomorrow will be a very interesting day to see whether this bounce we're gonna keep bouncing, or we're gonna the market gonna reverse and keep going down. So we don't know. So let's watch out for tomorrow to see the market's going up or down, and if the market's able to hold, then that would be a bullish scenario. If the market kind of reverse this dead cat bounce, then I don't know, maybe we're gonna be hiding. We're heading into even greater decline. Another thing I want to draw you into attention is that at the peak of the market, you will see something like a major ticker, like a major stock, right? A major company that's worth that's like a huge company, like $100 billion market cap company that's moving 8%, 10% in a day. One thing I want to bring you to attention is Microsoft. So if I show you, let me just show you the Microsoft symbol. I'll put that into a line graph. So this is a Microsoft. Sorry, I made a mistake here. I need to compare symbols so it's in the same scale. Just give you guys an example of what's going on here. For example, Microsoft. at the height of 2008, you can see that is when the market was declining, the thing was start jumping to all-time high, and that was literally the height of the market, the height of Microsoft. So if you thought, you were here and you thought, I mean, right now the market definitely looked really bullish. It's a multi-year bull market in 2008, and then Microsoft is jumping. You would think, a lot of people thought Microsoft's breaking out, but you can see the index is going down, right? But Microsoft is going up by quite a bit. And if you bought here, you thought that Microsoft was going to break out to even higher level. Bam, you literally bought at the top, right? In 2008, and that it dropped from $36 to 15. So you would lose more than 50% of your holdings, and if you have a leverage, then you are basically wiped out by just buying here. And it's kind of interesting to see that the big money, they would jack up the price, give the retail investors a false sense of breaking out, and all the breakout buyers who are amateurs, they buy in, and the big money was able to liquidate their holdings, right? That's one of the strategy. These kind of market top, and you can see that here, Microsoft is actually moving pretty drastically every day. Like I think this kind of pattern that's moving really drastically. Like today, it went up like 7% or 8% for a company that's the size of I don't know. What's the Microsoft? So Microsoft market cap is like 670 billion, right? It moves by 8% today. That's a huge amount, the movement, and that's just pretty abnormal to me that it would move that much in a day. And it looks to me that we might be in a distribution phase because it's moving so rapidly. You have a lot of shares changing hands, and let me just take a little bit of volume here. Yeah, the volume is pretty big, and again, like the volume here is not indicative of the actual volume because we have a lot of dark pools and all that stuff right now, right? So the actual transaction of large block of shares are actually not happening on the regular stock exchange, and it won't be reflected here, unfortunately. But we can look at the price action to see that for $700 billion company, it takes a lot of energy. It takes a lot of transaction to move the shares around like this much, right? And the volatility is pretty incredible right now. So that's the, and I mean, there's no earnings or anything, so there's no news that's affecting the price right now. It's just pure volatilities and transactions. So that's something that's kind of interesting. I've seen these kind of behaving a lot of large cap tech stocks right now, like Google. I think Google today went up a lot as well. Yeah, Google today moved quite a bit as well. Also Facebook, all that stuff. So yeah, keep that in mind. We're in a pretty volatile period. If you don't want to trade, if you want to stay on sideline, that's fine. It's totally fine. We have to, again, I want to see the pattern. I want to invalidate this pattern, right? Sorry. I want to see this pattern to disappear. I don't want this thing to, tomorrow it's going to break down, go even lower, and that would be really bad news. So that's it. Good luck, guys.